September 13th, 2008. Dick Fuld, CEO of Lehman Brothers, is calling Bank of America CEO Ken Lewis. His calls aren't being returned. By Monday morning, a 158-year-old bank would be gone, and the world would not be the same. This is the Capital Files, and today we're opening the classified files on the weekend that broke the world. Lehman's past was glorious. Its math wasn't. Lehman Brothers wasn't just another investment bank. Founded in 1850 by three German immigrant brothers in Montgomery, Alabama, it had survived the Civil War, 2 World Wars, and the Great Depression. By 2008, it was America's fourth largest investment bank, employing 26,000 people worldwide and holding $639 billion in assets. But there was a problem. For every dollar of capital Lehman held, it was borrowing at least $30. Some reports say the leverage was over 40 to 1. The firm had become a financial house of cards, and the cards were about to fall. Richard Dick Fuld Jr., known as the Gorilla of Wall Street, had steered Lehman deep into subprime mortgages throughout the 2000s. Firm didn't just buy these toxic loans. They created them, packaged them into bonds, and sold them to investors worldwide. By 2007, Lehman held $111 billion in commercial and residential real estate assets, more than double from the previous year. When housing prices began to collapse, Lehman was trapped. But the real danger wasn't just falling home prices. It was the hidden leverage that nobody wanted to talk about. Behind the scenes, Lehman was using an accounting trick called Repo 105, or as we like to call it, Wall Street's Photoshop. They'd move $50 billion in debt off their books right before earnings, snap the quarterly photo looking healthy, then quietly move everything back. On September 10, 2008, Lehman announced a staggering $3.9 billion quarterly loss. The writing was on the wall, but Fuld refused to read it. After all, who wants to admit their masterpiece was just digital manipulation? September 12, 2008, 6:15 p.m. The New York Federal Reserve's palatial headquarters in Lower Manhattan. Treasury Secretary Hank Paulson stood before the assembled titans of Wall Street, CEOs from Goldman Sachs, Morgan Stanley, J.P. Morgan Chase, Citigroup, and others. His message was clear and brutal. There will be no bailout for Lehman. The only possible way out is a private sector solution. Paulson's reasoning came down to one doctrine: moral hazard. If the government rescued every failing giant, Wall Street would only gamble bigger next time. It was a principled stand one about to be tested in the most brutal way. But behind those closed doors, something even more shocking was about to unfold. Ian LeWitt, Lehman's CFO, knew instantly it was over. That night, he would write in his bankruptcy affidavit that government officials had made it clear that emergency federal funding would not be forthcoming. Paulson and Timothy Geithner, president of the New York Fed, laid out 3 options for the Wall Street CEOs. Door number 1, create a private liquidation consortium to gradually sell Lehman's assets. Door number 2, form a consortium to buy Lehman's worst assets, allowing either Bank of America or Barclays to acquire the rest. Door number 3, prepare for global financial Armageddon. Nobody wanted to seriously consider door number 3. They should have. Bank of America had been circling Lehman for months, but when they saw the books, CEO Ken Lewis ran for the exits. British bank Barclays seemed interested until UK regulators took one look at the American mortgage mess and said, absolutely not. By Saturday night, the phones had gone quiet. Nobody wanted to be photographed next to a sinking ship. September 14th, 9:45 a.m. The final blow came from across the Atlantic. British regulators had killed the Barclays deal. At 10 a.m., Paulson delivered the death sentence to the assembled bankers. Deals off. Bank of America chose. Merrill Lynch instead, a smaller fire with a fire brigade on the way, as one banker put it. For Fuld, This wasn't just business rejection. This was betrayal. That evening, Lehman's board gathered for their last conference call. SEC Chairman Christopher Cox delivered the final verdict with bureaucratic precision. You have a grave responsibility, and you need to act accordingly. Translation: file for bankruptcy. Tonight, at 10 p.m., Dick Fuld leaned back in his chair, suit jacket off, empire gone. The gorilla of Wall Street had been caged. But while Fuld fought for survival in boardrooms, tens of thousands of employees had no idea their entire futures were about to vanish. Their mortgages, retirements, and savings were already circling the drain. In the early hours of September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection. The numbers were staggering: $639 billion in assets, $613 billion in debt. It was the largest bankruptcy in U.S. history, 6 times larger than any previous corporate failure. When markets opened Monday morning, chaos erupted. The Dow Jones Industrial Average plunged 504 points, its steepest decline since 9/11's. But this was just the beginning. Credit markets froze as banks stopped lending to each other, terrified of who might fail next. Money market funds, considered among the safest investments, saw massive withdrawals as investors panicked. The Reserve Primary Fund, which held $785 million in Lehman debt, broke the buck. Its shares fell below $1 for the first time in history. For millions of everyday savers, money market funds were supposed to be untouchable. That day, even their last safe dollar looked unsafe. For millions of ordinary Americans, this was the moment they learned that even safe money wasn't safe anymore. And this was the moment when fear turned into something far worse: a complete loss of trust. The panic wasn't confined to Wall Street. Global stock markets lost approximately $10 trillion in value following Lehman's collapse. Banks from London to Tokyo tightened lending, creating a worldwide liquidity crisis. In the U.S., unemployment would surge from 6.1% to over 10%. $5 trillion of American household wealth evaporated in just 3 months. The Great Recession had begun. But here is the twist that still haunts financial history. Just 2 days after Lehman was allowed to die, the same government that preached moral hazard rushed to bail out AIG with $85 billion. The insurance giant had insured many of the toxic mortgages that Lehman had created and sold. One company was sacrificed while its partner in crime was saved. Why the double standard? AIG's tentacles reached deeper into the global financial system. But that explanation felt hollow to the 25,000 Lehman employees who lost their jobs, and to Dick Fuld, who would never forgive what he saw as selective salvation. When the stock collapsed, 25,000 people didn't just lose jobs, they lost everything. Families who'd worked for Lehman for decades suddenly couldn't make mortgage payments. Retirement accounts evaporated overnight. Some employees had invested their entire life savings in company stock, believing in Dick Fuld's promises. One Lehman secretary later testified to Congress. "I worked there for 18 years. My whole retirement was in Lehman stock. Now I'll probably die at my desk." Meanwhile, Fuld walked away with nearly $500 million in accumulated pay. He later introduced himself at parties as the most hated man in America, as if that were somehow charming rather than tragic. If this were a Hollywood script, you wouldn't believe the ending. But this wasn't fiction. It was the real cost of Wall Street's arrogance. Lehman's collapse wasn't caused by a single factor, but by a perfect storm of greed, leverage, and regulatory failure. The firm had excessive leverage, borrowing 30 to 40 times their capital; toxic assets, $111 billion in real estate exposure at the worst possible time; accounting manipulation, using Repo 105 to hide debt and appear healthier than they were; leadership failure, Fuld's refusal to face reality until it was too late; oversight gaps, auditors flagged risks, But Repo 105 slid through the cracks of rules, never designed for a storm this size. But why was Lehman left to fail while AIG was saved just days later? For the government, the answer was moral hazard. If every failing bank was rescued, Wall Street would never stop gambling with other people's money. Lehman became the sacrificial example. Yet, as the panic spread, officials realized AIG was different. Its collapse would not just sink one firm, it would drag down the entire global financial chain. Lehman's failure was meant to teach a lesson. AIG's rescue was meant to keep the system alive. The Dodd-Frank Act and other post-crisis regulations were designed to prevent another Lehman. Banks now hold more capital, undergo regular stress tests, and face stricter oversight. But as we've seen with recent bank failures, the financial system remains fragile. The weekend that broke the world serves as a stark reminder. In finance, confidence is everything, and once it's lost, the collapse can be swift and brutal. Months later, the key players faced Congress. Dick Fuld, still defiant. This loss of confidence, although unjustified and irrational, became a self-fulfilling prophecy. Hank Paulson, defending the decision. We didn't have the legal authority to save Lehman the way people wanted us to. Timothy Geithner, reflecting on the choice. It was going to be bad either way, but we believed letting Lehman fail was less catastrophic than the moral hazard of endless bailouts. 3 truths, 1 collapse: pride, policy, and fear. History is still debating which weighed most. And if all this sounds familiar, remember Tulip Mania 400 years earlier. Human psychology hasn't changed. We just find new flowers to chase. Back then it was tulip bulbs. In 2008, it was mortgage-backed securities. Tomorrow, who knows? But the pattern remains. Greed, denial, collapse, repeat. The files on Lehman Brothers remain open, reminding us that even the mightiest financial empires can crumble in a weekend. The question isn't whether another crisis will come, but whether we've learned enough from this one to survive it. This has been the Capital Files. If you found this deep dive into the weekend that broke the world compelling, don't forget to hit that like button. Subscribe to the Capital Files for more untold stories from the history of finance. And leave a comment below. What do you think is the biggest lesson we learned from Lehman's collapse?